Hey, everybody, welcome back. We have an amazing episode coming your way. First up, we're joined by our pals. We haven't seen them in weeks, Vinny and Sunny, for another edition of the Crypto Roundtable. We chop it up about the government crackdown on the crypto sector. We also have a very in-depth discussion on which agencies should regulate crypto and how. Then producer Rachel is joined by Prince Ghosh, the co-founder and CEO of Factored Quality, which offers software and managed services to help book trained quality control inspectors to inspect goods. Yes, she found a Gen Z startup founder working on quality assurance. It's going to be a great show. Stick with us. This Week in Startups is brought to you by Microsoft for Startups Founders Hub. Microsoft for Startups Founders Hub helps all founders build a better startup at a lower cost from day one. Startups get $150,000 in Azure credits, access to OpenAI APIs, free dev tools like GitHub, technical advisory, access to mentors and experts, and so much more. There is no funding requirement, and it only takes minutes to join. Sign up today at aka.ms/thisweekinstartups. Merge. Let your developers get back to their core product. Merge is a single API to add hundreds of integrations to your app. Integrate up to 5 customers for free today at merge.dev/twist. And pilot.com. Pilot takes care of your bookkeeping from start to finish, so you can focus 100% on making your business succeed. Go to pilot.com/twist for 20% off your first 6 months of Pilot Core.
Okay, everybody, it's Wednesday. It's been far too long, Molly.
So long. I barely recognize these guys.
Okay. Let's get started, Molly.
Let's do it. We are back with the Crypto Roundtable at long last. Maybe our last one, because the industry is about to get smothered like a baby little flame in the woods, snow falling on it. No, there seems to be a crackdown. It seems like maybe the story of 2023 is going to be the crypto crackdown. And so we got our experts back to talk to us about it. Sunny Madra, co-founder of Definitive Intelligence, and Vinny Lingham, co-founder of Civic and Wait Room for one-on-one video conferencing, because running 2 companies at the same time is just the thing to do. It's just what you do these days.
Well, I'm technically just chairman of Civic at the moment, so not running it operationally. But thank you.
All right, listen, it's been a long time since you've been here. I think we took a little break because everybody's been busy, the holidays, yada, yada. But we woke up last week and there was somebody who said like a week ago, and I think this was in one of our group chats. I don't know if it was in our poker group chat, Sandeep, Mr. Madra, or if it was in our Twist one or the crypto one. But somebody, like a rando, is like, I hear there's going to be a bunch of crypto SEC actions. And then sure enough, next couple of days, we saw some crackdowns. So I think we need to unpack that. Did you see this coming, Sandeep?
Well, yeah. I mean, look, the one thing, let's level set as we get into this conversation, right? Because, you're dancing on the grave a bit early here, J. Cal. And,
I don't want to dance on the grave. I'll explain my position in a moment.
But let's kind of frame it, at least a framework that I use is like blockchain technologies, say Web3 applications, and then cryptocurrencies, right? And what we're seeing now is a lot of regulation coming around cryptocurrencies, but blockchain technologies and Web3 applications are not getting looped into that. So I think we should just keep those things separate, because I think a lot of it gets looped together, and then I think that doesn't help the folks that are really innovating in the industry right now.
Well, let's also just define the roles of the government agencies, right? So the SEC is claiming jurisdiction over basically all of crypto at this point.
Cryptocurrencies, Vinny. Cryptocurrencies.
Yeah, cryptocurrencies, right? So the CFTC says that they have Bitcoins under their jurisdiction because it's a commodity. You have, we have, first of all, a jurisdictional battle, and potentially I think there should be a separate agency, but that's just, I think there should be a digital assets agency that gets created, but that's a separate view. And I think that trying to get these agencies to, they still have to go to court and fight this. And the SEC has lost a couple of battles in court already, in the cryptocurrency world. So it's not fait accompli that the SEC has, jurisdiction, and that if people are breaking the law or are breaking law, that the SEC has the right to enforce action against them. So they can be challenged. And Coinbase has made it very clear that they're going to go and fight in court, and I think others will do the same. Circle will do the same, etc. So, when you say there's a regulatory crackdown, I agree. I think that it's debatable which agency leads the so-called crackdown, but I think we are going to see, governments around the world crack down a lot more on crypto in general. The flip side is governments can never coordinate anything, so they can't really coordinate attacks between different governments, and some jurisdictions will be friendly towards crypto, others won't be. So this is not going to play out over 3 months, JK, or 6 months. This is like 5 years, like the next 2 administrations at the US level and probably other parts of the world. And so in that time, I think crypto has a path to escape velocity where, like Bitcoin, no government can actually shut down Bitcoin, even if they wanted to. They can shut down the gateways. So you can say, well, we won't allow money transfers from banking into Bitcoin. They can try and depress the price that way. But on a long enough time frame, the decentralized cryptocurrencies will be outside the purview of governments because you can't stop it.
Okay, just a level set here. I loved your definition, Sandeep. There's the Web3 application level, there are cryptocurrencies, and then there's the blockchain. I don't think we need to define those things. Everybody understands what you're talking about on This Week in Startups. If you don't, you can look up cryptocurrencies, blockchain, and just a Web3 definition. I don't think that requires any definition on a show of this level of sophistication. However, Molly, being the expert you are on all things finance, perhaps you could catch us up on the mandate of CFTC and
so
SEC and the difference between those two to then catch us up on Vinny's position that, hey, which agency should be involved in this? Who do we call?
Right. Which is and that's an outstanding question, right? It's sort of how a lot of times you might see like volleyball, nobody calls the ball between the FCC and the FTC, right? And those mandates might overlap. And in this case, you have these two agencies, the CFTC, which is really all about the trading. It's this relatively new federal agency that deals with derivatives markets, futures contracts, options, and swaps. Then you have the SEC, which is all about protecting investors, maintaining efficient markets, facilitating capital formation. And both of them seem to sort of fundamentally be saying, and possibly rightly, we have some reason to come in here. There are aspects of the cryptocurrency universe writ large that are 100% about swapping and derivatives and futures and the kind of financialization that we've talked about on this show for a year now. And you have the SEC saying, these are pretty clearly investment vehicles in some cases. We are going to classify them as securities because they seem to follow all those rules. So I guess what you're saying, Vinny, is maybe like both have jurisdiction or none, or this could get delayed, this sort of idea of enforcement as these two agencies
Before we do that,
fight
Molly,
it
can we
out.
step back for a second and maybe just, I think we have in the notes the mission statement of each one, or maybe in the Slack. Can you just read those so that we just level set with the audience? Because they hear SEC, they think they know what that is. They hear CFTC. And I couldn't read you off the top of my head the mission statements, but I think it's important to take from their website exactly what they said.
Yes. The Securities and Exchange Commission has a 3-part mission: protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation.
Got it.
The mission of the FTC is to promote the integrity, resilience, and vibrancy of the U.S. derivatives markets through sound regulation.
Got it. Okay, it's pretty clear.
Yep. And then their mandate is, according to Investopedia, they're the federal agency that regulates derivatives markets specifically.
Got it. Yeah. Doing more with less is more important than ever. You know this, especially for startup founders. We all have to be efficient. And if you're running a startup, I want you to know about the Microsoft for Startups Founders Hub. It's a no-brainer. They're going to help you scale efficiently while preserving your runway. How are they going to do that? Well, they're going to do it with the best startup program I think we've ever seen. Up to $150,000 in Azure credits, plus access to OpenAI's APIs. Think about that. As well as the new Azure OpenAI service. And listen, there's other things that Microsoft has available to you as part of this program. How about free access to GitHub and Visual Studio? How about one-to-one technical advisory and expert help on topics like product, fundraising, and go-to-market? How about access to a network of mentors that are plugged into the startup world, plus free access to partners like LinkedIn and Bubble, which can help you build your MVP even quicker. Microsoft's so generous. The Microsoft for Startups Founders Hub is open to everyone. Whether you're in the idea phase or you're further along, there's no funding or requirement. They want any founder to be able to get access because they want all founders to succeed. It's really a no-brainer. It takes 5 minutes to apply, and startups can get massive benefits immediately. Go to sign up right now. Let's take a pause and write this down, everybody. aka.ms/thisweekinstartups. Like I said, most generous program I think we've ever seen on this podcast. aka.ms/thisweekinstartups. Thanks again, Microsoft. All right, so that's what they say on their website. So Vinny, when you look at those two things, to Molly's question, like how do you interpret where specifically staking, because that is the action we saw this week, is the act of staking. Where would staking fit for you here and why?
So this is why, first of all, I don't believe that two agencies can have jurisdiction. Because then who takes enforcement action when there is action? So I do think that that's a conflict. I think that staking should be defined into an entirely different. This is why I think we're missing an agency. We're missing a digital assets agency or something.
Okay.
And I think that if you think about what is staking, right? I own some Solana and I go put it into a smart contract, and people who need to use that Solana pay me some sort of a return for using it. Whether it's if you do native staking with the network, then I'm saying I trust a certain validator, and I will get rewards back from the network as they print. So I get a share of the rewards, which is very predictable. There's no, and it's not dollar denominated. I'm getting it in the actual currency that I'm staking. And then obviously you get different types of staking. That's just Solana, but different types of staking, which you get paid a reward, a certain rate of return for it. The quest, I mean, like the SEC, I see their point. This is a way of making money, so to speak, but it's not money. It's not US dollars. No one's promising me a return in dollars. It's fixed in the unit of cryptocurrency I'm getting. So it's like, I go buy seeds at a plant store. I plant a tree and it gives me apples, right? And then I take those seeds again and I go replant them and give apples. I'm not getting dollars growing off trees. I'm getting apples. So
your argument there and your definition of staking is you put something in, you get more of it back. Sometimes it's transformed. We do know that happens sometimes. It throws off some new currency or token, but it's not currency, even though people paid currency to get it. Sonny, how do you define staking?
And so let me just add to 1 second. I'll be even more put more finer point to it. If the returns are dollar denominated or any fiat currency denominated, I think that's within the jurisdiction of the SEC. If the returns are not denominated in the fiscal currency of a country or of a sovereign region, and it's denominated in the underlying asset rewards, like Bitcoin, for example, as well, as if you're a miner, you're earning Bitcoin. I don't think that's under the jurisdiction of any government, because if I go and put in X amount of my asset to earn a bit more of that asset, it's like me having a sheep, and the sheep has a baby, right? Like,
got it. Okay, it's a great analogy. I think we understand it. Sonny, maybe you could try defining staking for the audience. Explain staking, what it is, and maybe why the SEC is taking these actions against stakers.
Yeah,
or maybe really just define it. Just define staking.
I like Vinny's description of it, right? I think the core of staking comes back around to these are meant to be decentralized networks, and these networks operate with their currency, their own currency. And how that economy works is by, especially when you move away to less energy intensive blockchains, those things require like a trust system. And part of that trust system is, for there to be staked currencies that are in it. It's just sort of, it's how these, sorry, I'm just kind of, I really like Vinny's explanation. I'm just trying to expand it. It's like, we want to have these decentralized networks that aren't owned by anyone, right? We've debated why, right? They can be composable, like they can run forever. There's no one person responsible for them. And so in order for that to work, you need kind of staking as part of the underlying system for the blockchains to work. And so that's really where it comes from. And the return is related to, people are using their computers, right? And the resources that come from that. And so I think what's happened is, though, people have taken that and expanded beyond it, and that's when it's gone, similar to what we talked about before, what happened with that GBTC trade, right? People have gone in there and it starts to kind of become the core of other things. And so I think that's the danger, in my opinion.
Right. this has been, and this was a pretty big action that we saw last week, over the past few days-ish, which was that Kraken was fined for this staking as a service product, because you had staking and then you had staking pools. And this is where not only is Gary Gensler and the SEC, not only are they wading in with fines, they're actually like trying to do some education around this. So we pulled up this video of Gary Gensler chiming in on Twitter about why the SEC is banning staking.
Here's the rub. When a company or platform offers you these kinds of returns, whether they call their services lending, earn, rewards, APY, or staking, that relationship should come with the protections of the federal securities laws. That means you, the investor, should receive important disclosures. For example, what do they actually do with your tokens? Are they really staking them? Are they lending, borrowing, or trading with them? Are they commingling them with their other businesses? Where do the rewards come from? Are you getting your fair share? Are the underlying crypto protocols genuinely creating value on your investment? Or are they just new tokens that dilute the value of ones you already have? Remember, if you have a stake, that's S-T-E-A-K, if you have a stake meant for 2 and cut it into 3 pieces, it's still the same amount of stake. Unfortunately, because these staking as a service providers generally are not providing proper disclosures, there's currently no reliable way as an investor to know the answers to these important investment questions. Plus, when you sign on the dotted line or accept the terms of service, you are generally agreeing that placing your tokens with these providers may mean transferring your ownership to them. There's an expression in crypto, not your keys, not your crypto. You see, you're basically an investor in their platform. If it goes under, and we've seen plenty of that recently, you end up in line in the bankruptcy court. That's why it's so important that these companies and platforms comply with the securities law. After all, the securities laws, regardless of what you think of stake or staking, they're good for investors.
All right, so give us your, so this enforcement action was also seen as putting Coinbase on notice, side note. And then what do you think is in here? I'll start with Sunny, that is fair or not fair, or both?
You know what? I hadn't seen that one before. I actually liked it. I think, he talks about the core issue. Look, the staking technology was fundamentally part of what, makes blockchains work, right? And it's been used, it's been turned into something else, and people are using it. And you saw the description, whether it's earn, APY, and that wasn't what it was originally meant for. People have packaged it up, staking as a service. And then when you're doing that, I think you touched on, I really liked the video. I mean, I thought it was accurate. You touched on all the key terms. Yeah.
Yeah. Good job,
I haven't seen it either. And I actually agree with Sunny. I think it's accurate. I think here's the issue, right? The issue is that the SEC can and should regulate Coinbase, Kraken, etc. And Kraken could have gone and fought the fine as well. They didn't have to accept it. They should regulate it, because these services are providing a layer on top of staking, right? They're creating pools. They're taking custody of funds. That is all within the jurisdiction. I mean, these are regulated entities. They should be under jurisdiction. My argument is not that they shouldn't. My argument is that the rules should be set that if you are taking this money in, if you're enabling pools or you're enabling it, but you're not taking custody of the funds per se, you're enabling like a multi-sig contract, that's fine. The moment you take custody and you're paying out APY and you're taking some cut, there should be, as a service provider, within the framework of the law, there should be some rule set. The corollary of that is, if I go directly to the Solana network and I go stake my coins with the validator, the SEC should have nothing to do with that. It's got nothing to do with them if I'm going directly. And I think that's what Gensler is actually saying. He's going after the providers of these staking services, not the notion of staking itself. That's my read.
Yeah, I think that's true. I think it's a pretty nuanced and good take. Jason, what are your thoughts?
Finally, the SEC is proactively educating and discussing very complex issues with the American public. This is fantastic. So I am very pleased to see the two OG crypto peeps that we have here, Mr. Madra and Mr. Lingham, saying they like this video. I think that this is what the SEC needs to do. This is targeted at consumers. So although it's a little goofy cutting the steak into 3 pieces and using a stock image, you know, and making it like a TikTok video, well, that's how people consume. And those are the people who are attracted to this. And the SEC is meeting consumers where they are. We said before, hey, what is the mandate of the SEC? And you read, Molly, from their website, protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Now, the last one is about, you know, what we do for a living, making venture firms and syndicates and stuff like that. Let's put that aside. But a fair, orderly, and efficient market means, hey, people need to be educated. And protecting investors, people need to be educated. They need to understand it. And it's delightful for me to hear our OGs here, our crypto OGs say, yeah, that's what we need to do. Now, does it need a new agency? I think it needs an agency to do new things. We don't need a new agency. We need an agency to do new things. And the new things this agency needs to do is sit down with crypto people and say, tell us everything. And how would you like to proceed? And then say, here is how we already do this. We can only make so many changes to this because there's this Congress and, you know, the public, and they get to vote on things and they get to have a say here. So we can make some changes, but generally speaking, you're going to have to play by this rule book, and this rule book changes slowly. Listen, it's 2023. Closing business-to-business deals is going to be harder this year. You know this to be true because companies, hey, they're tightening their belt. It's the year of austerity, and it's the year of focus. The last thing you want to do is slow your sales team down with a lack of integrations, right? These days, business-to-business buyers expect integrations. We expect our people management tool to work seamlessly with our payroll provider. We expect our CRM to work seamlessly with our accounting software. If it doesn't, it's a huge issue. But when you start a company, integrations are brutally hard. They take a ton of time, but Merge makes them way easier. Merge is the leading unified API that allows you to launch integrations in days, not quarters. Think about that. All of these integrations are out there. What if you could just have, boom, over 150 different integrations across 5 different categories? Human resources, information systems, ticketing. It's all just built into Merge so your developers can get back to working on the important parts of your product. Merge is the leading unified API that allows you to launch integrations in days, not quarters. That's all you need to know. So here is your call to action. Merge has unlimited integrations, and they charge based on how many of your customers use these integrations. So here's what they're going to do. They're going to give you 5 linked accounts for free today at merge.dev/twist. Again, 5 linked accounts for free. There's just no cost to you. Free. You know what the word free means. Free. merge.dev/twist. I've been sitting here, and a lot of this comes to my own personal jealousy of crypto. And I will put that out there absolutely honestly. I am incredibly jealous that capital formation for crypto companies can be done with anonymity, with global scale, with absolutely no fees. It's extraordinary what crypto has built. And I would like to deploy that at thesyndicate.com to invest in companies. I would love for everybody to send me a fraction of a Satoshi and ETH, some garbage NFT, whatever. I don't care how they get the money in. And I could have 1 million people put in $1 each and then put $1 million into a startup. That is my ultimate dream. The SEC is a blocker. I can't do that. I can't ask 1 million people for $1 without doing a crazy SEC public filing. But the 2 crypto people we have on right now could have that up and running in under 30 days, probably in a week.
Yeah.
And so the potential here is so great.
They did that, right? The Constitution DAOs.
DAOs have done it.
Yeah.
And DAOs clearly fall under SEC facilitate capital formation. But so that is my personal bitterness. As I've given this some thought, I'm very bitter that I can't do this kind of stuff. And I am unable to break the rules at scale because I have people who work for me. I have a family. I can't just go out there and break these rules and stick it to the SEC. I want to continue to be free and not in jail. But I'm actually considering when I watch this, like, maybe I should move to the Zug Zug, wherever the hell that is, and I should just YOLO it and just not take Americans' money and put this offshore. So the existing agencies, the old dogs need to learn new tricks. That's my position on it. I'm putting my cards out there. You can clip this. You can aggregate it. You can make a TikTok and dunk on me. I'm jealous. I want to see this vision occur. And I want the SEC to proactively engage this group. And I want this group to stop stealing from people.
So Jason, I think you have to be a little like, let's just be a little bit more intellectually honest here, right?
Let's do it.
Okay.
I'm here for it.
So I'll ask you the questions. So why do you want to have a big fund and do capital formation with so many people?
Why do I want to have a capital formation with so many people?
Yeah.
Oh, it's actually, that's such a great question. We could fund more companies that take more risky bets.
Okay.
And do it with less cost, less time, and the people who make the bets would have less problems. They would have less damage if it doesn't work. And the majority of startups don't work. We would say 80% at the seed incubator stage don't work. So what if we made it 90% don't work? Well, if people are putting in $50K each, that hurts. It can sting. And they're accredited investors. You get 20 of them for $50K. It would be much better to have 1,000 for 1,000, 10,000 for 100, 100,000 for 10, or $1 million for $1. But the problem is speed. When we do this, we have to have people sign documents. We have to have them wire money. The wiring costs are greater, Vinny, than the costs that they're investing. So we set a $4,000 minimum for the syndicate, just because doing the tax documents for 10 years is so arduous that 250 people versus 50 people in the tax documents makes a difference. And collecting 250 signatures versus 50 is obviously 1/5. So it's just the speed. And then also for the investors, more people could participate. And that would be more fair. So I have that reason as well. Great question.
So as you're going through this thinking, your argument really is that you can spread the risk
yes.
across a wider base. Do you think you'd raise more money than what you can raise currently?
There is a gating factor, which is how much money the startup wants to take in. And so we wouldn't want to flood a startup with $10 million at a $100 million valuation at that stage. Let's say the company has...
No. But I'm saying the fund that you're running, right?
I think
are you more SPVing? Are you saying more from an SPV perspective?
From an SPV perspective, or even a fund formation perspective, sure, we could have more people participate in funds. But just let's just stick to the SPV concept, like one deal at a time. More people could participate. We wouldn't have to exclude 95% of the people in the United States, and we wouldn't have to exclude, whatever percent it is on a global basis. And then that could make more people move up from poor to middle class to rich to, the rich don't have a problem. They have access already.
I struggle a bit with this, Jason, because I think one of the things I've learned as an angel investor is making lots of like 10K, 25K bets. You get like hundreds of these companies in your portfolio that you spread out. The administrative costs following up, you don't keep track anymore. At this point, like when you're in the sort of high net worth individual, you just actually forget about it. You write the check, if it comes back, fine. Otherwise, you don't track it, you don't monitor it. The ones that do come back, if you're lucky, it's a 10x, and then it doesn't really move the dial.
Or 3,000x.
Well, so you get a couple of those. That's great. Like
you get one in a lifetime. I think you get one in a lifetime if you're lucky.
You get a couple, but
4,000x. Yeah, who's counting?
I guess the point is, you need to take enough of those bets for that 3,000 to come along. Okay. And
sure, it's a risky bet, which means even more reason people should spend just $10 or $100 making
exactly. Like let's say I can make 10,000 of those at $2 each or $1 each throughout a year, and it becomes incremental. We're not talking about high net worth individuals making these bets.
I'm a big fan of crowdsourced capital. I'm a big fan of opening it up for people.
That's really the issue. It's just if they choose to, they have access. Sonny, what do you think?
But now they have to trade. They have to trust you as a picker.
Yes, and that's the great thing. You then would pick the fund managers. Their fund managers would have their track records. You would get to choose. Hey, I trust Jason. I trust Molly. I don't trust this person. I don't trust that person. And they write a good deal memo and they keep me up to date on it. You are outsourcing the management of that investment. Just like when you're buying Netflix stock, you're saying, hey, I trust this management team. But Sonny, what are your thoughts on this and my confession of my jealousy and the overall reaction here to this action?
I'm still processing. Well, look, we have systems in place to collect lots of small amounts of money from folks, lottery tickets. right? That infrastructure exists. It runs multiple times a week. Sometimes you can 700 million X your money, right?
Hot take coming in.
Right?
I love it.
So, the systems exist to do it. I think the structures that are, no one is, protected from buying lottery tickets, right? Like you can buy one, you can buy $1,000 every time. So I kind of feel like there's a philosophical conversation that has been kind of layered out within society that has us in this spot, because it's okay if, when the Powerball goes to, whatever, couple hundred million or billion, it's been a few times, right? No one stops people from buying, whether it's $1, $10, or $1,000, right? And the odds of return there are really bad, right? Like,
And what do you learn?
Nothing. And so
nothing.
I think there's like some societal constructs here that are really, are holding people back. And it's less about the technology or anything else, because we enable it in other places. And so that's
so interesting that you say that, because we are also in the midst of throwing open the barn doors on sports betting in the United States, which is a very similar,
great point.
I mean, right, if it's all just gambling, Nick, now we're saying like, yeah, you can bet all you want. I mean, the truth is that finance is always gate-kept finance. And that is why Bitcoin was conceived, right? Was to like tear down these walls like barbarians at the gate. Enough with this. And then to get back to the SEC and kind of this enforcement question, the old demons of finance co-opted a lot of this. And I would argue the SEC doesn't actually need to learn that many new tricks, because what they're talking about now is protecting investors. The CFTC is talking about derivative swapping. Like, once the tools of finance were applied, then it seems to me that the old gatekeepers of finance 100% apply here. They 100% have jurisdiction. The question is, what can survive and what should survive of the original vision? Like your point, Vinny, right? If you stake one Solana, one Sol, fine. Nobody cares. I don't even think Gensler cares. I think it was like pretty clear from his video that he's like, I don't care. It's when you financialize this thing that you may run afoul of traditional finance gatekeepers. And also, we should probably acknowledge that I'm sure banks still don't want this to exist. So, like, is the mission of enforcement that could be 100%
cynical.
legit going to get wrapped up in this idea that, like, the gatekeepers ideally would love to strangle Bitcoin in the crib?
This is why I got to get Brian Armstrong back on here, because this is a very calm discussion. This got a little heated.
Yeah, exactly.
No, I do. I'm a fan of Brian's. I'm a fan of
saying,
Jeremy
does he
Allaire.
want to come on? Because he seems mad at you now.
I think so.
Yeah.
I think he'd prefer to come on all in. I don't think he wants to face me alone. In all cases, he actually came on the podcast before they were public, and then after they were public, he asked to come on all in passed. We don't really do guests all the time. I said, hey, come on this week's startup. Then he passed on that. So I was like, all right, you know what? And then he decides he's going to dunk on me. So I don't think Brian, and I'll say this directly to him, I don't think he wants to have a hard discussion one-on-one with me. I think he wants to, have it with the other three besties there, so he doesn't have to face my level of criticism. He then pull up the tweet just from Brian, not mine, please. He decides when I say like, hey, crypto needs to play by the rules. He's like, disappointing to see you duped by this, Jason. There is no way for crypto firms to come in and register. It was fake. The SEC's own commissioner, Hester Pierce, who's been on This Week in Startups, is great. She's very well spoken, essentially confirms this. So I'm like, come on, man. You don't need to dunk on me and tell me I'm getting duped. Did you guys see this thread with me and Brian, by the way? I don't know if you saw it.
I saw it go down.
Okay.
Yeah.
So I said to him, listen, here's the facts. Crypto firms made up a new securities framework and ignored the rules. I believe that's true. Web3 startups and their VCs swept mountains of cash off the table from uninformed civilians. I believe that's a fact. And the SEC is here to protect civilians, and many crypto firms around, so they forced their hand around. Find out. So anyway, we got a little heated. What's fair about Brian's position?
Right.
I guess is the question, Molly. What do you think, Molly?
Yeah. I mean, does he have to take this position on some level? Because this question of enforcement of exchanges and pooled staking is more existential for Coinbase.
It's 11% of their revenue. Somebody tweeted. I don't know if that's the exact number, but it's some double-digit percentage of their revenue. So I understand that. And he's frustrated because he tried to go to the SEC. Remember that a couple of years ago? He tried to meet with them. They refused to meet with them, or they canceled the meeting. So what's fair about, what do you think of the exchange overall, Sandeep? And then I'll go to you, Vinny, because I see you're ready to go too.
I'm going to go back to the framework we started with, right? I think the challenge is, if you look back the origins of Coinbase, it was to buy Bitcoin, which is, turned into like a stable asset, right? Not in the way of like stable coins, but like at scale all over the world. The challenge is, every time I go in the Coinbase app, they're promoting all kinds of different financialization of, whether it's a staking product, an APY product. They're promoting, going back to your point, Jason, they're promoting random tokens that, we don't know the depth of like how much work the project has done, what really exists. And so from that perspective, I'm not a fan of that stance, right? Because, they're sort of driving the casino of cryptocurrencies. And they, and that leads to kind of Gary's point in that video, is that when people are doing that and then, they go under and you've either trusted them with giving your assets to them and they've staked it and done something with it, or they've promoted you buying.
So you believe he should be regulated. You believe, and you believe that as well, Vinny. If you're doing this formally like this, it's not a distributed project where you're getting, more baby pigs for the big pigs you put into the pool, or baby sheep.
Interesting.
Rabbits. I don't know exactly how to go. I put 10 rabbits in. I got a bunch of bunnies out. I made paella, rabbit paella.
I think protocols. So there's a couple of things the regulation should cover, right? Okay. So the issuance of the tokens, there should be some regulations around it. Mm-hmm. For example, if it's just a mined token, then it's mined, right? So if you want to just connect commodity hardware,
mined token, like a mined token, you did some compute like Bitcoin is mined.
Yeah, exactly. So you mine it. So by the way, there's already a framework for this right now. Like if you launch a cryptocurrency, even if it's a mined token, like a Solana or whatever else, or a stake token, if you have a sale, you can do a SAFT to accredited investors. You can place those tokens with them. There probably should be more clarity on like what they can do with it and how they can do with it, how they can sell it, etc. But that needs some more clarity. But that's already fine. I think the moment you get into the world of service providers on top of the protocol, that's where there's some regulations needed. But if I, as a consumer, want to go and buy a token because I think that, I think that a certain token, whether it's Render or Filecoin or Solana or whatever I like it, I get behind the project, and then I stake it and I earn more of those tokens. That's a long-term investment for me, right? So if I say I'm going to go buy 1,000 Filecoin and I'm going to stake it, and in 5 years' time or 10 years' time, I'll have 1,300 Filecoin, and I'm doing it with the network natively, that should be like my decision, because like if I'm going to hold it anyway, I might as well get some sort of yield or return on it. Now, the issue really is when you have these service providers in the middle. Now they're taking a cut. Now, now they're also promising you to juice up the returns. Potentially, they're doing funny stuff like leveraging your tokens. They're taking custody of it. Like Gary said very clearly, not your keys, not your crypto. And I've always been a fan of that saying. So it's really, Jason, it's so nuanced. Okay. But I think we have to understand, like, it's the ICO, the initial issuance, it's the protocol itself, it's the service providers.
I actually understand your very reasonable position. I think, Molly, this is a reasonable position.
I think we might all agree, even Gary.
It's like, so what is causing this riff here, Molly? If you were to look at this at the field, why do you think it's gotten to this point of contentiousness? I have my own theories. I'm sure the boys do too here, but here's your perspective as an outsider as well, and looking.
I really like your tweet about the arrogance.
Okay.
No doubt about it. Like, it has become, unfortunately, a little too easy to dislike Crypto Bros, present company excluded, because of this kind of sense of superiority and like, you're all fools and we're all getting rich without you. And I will confess to that kind of jealousy as well, especially after having lost my $300 worth of Bitcoin at $1 each.
To keep those Bitcoins, yes.
I would have liked an FDIC to be behind my purchase.
What consumer wouldn't?
However, I think the reason this is so contentious is just because it looks like traditional banking. And it's all this, and then it's going to be, and it's so hard. Like, Vinny, the thing you're 100% right about in terms of regulators is that they have not historically been good at scalpel surgery.
It's nuanced. Yeah.
It is really, really nuanced, because what we have here is sort of multiple entities within the host, and we have to carve out some and leave the others and not kill the host. And that is not a skill set. Like, these guys are not good at whatever that old surgeon game is. That's not a skill set the regulators have. And I think there's probably a very reasonable fear that they're going to come in and just be like, radiation, just like nuke the whole thing, and that'll be the end of it. And I think Gary Gensler is presenting right now the position that he wants a scalpel approach, but it sounds like there's just not a lot of trust.
All right, everybody, I'm here with Wasim Daher. He is the CEO and founder of Pilot. You guys know Pilot. They help everybody with their accounting, CFO, and tax services. Welcome to the program.
Thanks for having me.
A lot of talk about burn rate. How can a startup in this kind of climate reduce their burn and extend their runway?
Yeah, it's a great question. So burn ultimately, or increasing cash in your bank account, is a consequence of 4 basic levers. The first is revenue. Can you sell more to your new customers or existing customers? Can you raise prices? Can you do things that actually increase the amount of revenue you take in? The second is gross margin. Can you reduce the cost of providing your service so the same customers generate more cash for you? The third is payment terms. Can you get folks to prepay you annually? Maybe can you negotiate more flexibility with your own vendors? And the fourth, of course, is just decreasing costs. Are there expenses you can reduce or cancel? Are there investments you can defer until subsequent years?
Yeah, great advice. And you got to look at all 4 of these things. And man, sometimes a customer can pay a little bit more, and founders are scared of raising their prices. And sometimes they're lowering their prices when they should be, in fact, raising them because they're providing more value. So really think that through. Not just cutting costs, but also maybe look at how much you're charging. Maybe it's time to increase it a little bit. Great job. All right, listen, if you're a Twist listener, you can get 20% off for the first 6 months of doing your accounting with Pilot. Pilot.com/twist. That's pilot.com/twist for 20% off the first 6 months.
So let's look at Celsius for a second, right? Like, Celsius was the poster child. It is the poster child of, like, effectively, I guess in some ways, staking because of the whole Celsius token thing, and how they were promising ridiculous APY rewards, etc. Like, yeah. And most of these rewards are actually denominated in dollars. They were promising like dollar-based returns. So this goes on to the stablecoin discussion, right? Stablecoins should be regulated. Returns
Why
on
should
stablecoins.
Stablecoins? Okay, this is when I'm sorry to interrupt you. This is when I really want to understand. I got your position on staking. If it's decentralized and I'm getting back, puppies for having put these beautiful English bulldogs in, I get it. It's no cash. There's no APY. There's no central control. You didn't take custody. Great. You didn't take my bulldogs. They just magically appeared on the blockchain. Stablecoins are 1-for-1. And the Howey test says, like, hey, it's some group thing and there's some expectation of gain. With the stablecoin, there's no expectation of gain. So explain why stablecoins, I happen to agree that they should be regulated, but I'm curious your position on why should stablecoins be regulated? Because people were also upset about that, because I think the SEC came out and said, hey, we're going to make sure stablecoins are also regulated.
It's the word stable, right? The notion that is being put out there is that, it's a 1-for-1. And in the case of, USDC and Circle, they publish sort of their holdings and they make it very clear. In the case of some of the other tokens, some which we saw go to zero, which we didn't share that, the stable wasn't really stable. It was like either algorithmically stable or the underlying assets haven't been disclosed. And I think that goes back to the financialization discussion, right? That's like the what's being, and Gary said that in the video, what people are being told, does that line up to what is actually happening? And I think that's what you get with some of the regulation is the transparency. If everyone along, say the last few years knew that the APYs that were being offered were really just coming from an ARB that existed down in that GBTC thing that we spoke about a few times, maybe you wouldn't have put your money there. Right. And it was that clear in the documents. I haven't gone through them in detail to even know if that exists.
Did you lose any money in that, Sonny? Did you lose any money in that? In the whole debacle? The APY?
No, I've never, not there, but like I had money at FTX. So technically, yes, but like not a huge amount or anything. But and I invested in FTX, right? I think you did too. So they acquired a company I invested in, so I didn't technically make the decision to invest in them. But the reason I asked the question, Sonny, is that you'll find a lot of the OGs, myself, Sonny, and other people, I didn't get hit by Luna. I didn't get hit by Celsius. No. I didn't get hit by any of this stuff. In fact,
I didn't even get hit by FTX because I never traded on them because I didn't trust him in the first place. So, like we know when something looks and smells fishy because we've been around for a long time. And most of my OG friends weren't affected. It was the newbies that got affected by all these promises of these ridiculous gains. And so to answer your question, Jason, why I think stable coins need to be regulated. And let's just make sure that, for the audience, there's two different types of stable coins. There's algorithmic ones, and then there's asset-backed ones, okay? And asset can be cash or bonds or whatever else. I'll dismiss the algorithmic one for a second quickly, because Luna was an algorithmic one, but the Luna Foundation held custody of those funds, and so they were operating as effectively a bank managing the float for a coin. So you can argue it was algorithmic, but it wasn't really. It was, it was they had their mechanism that didn't quite work. So I think that if you find a true algorithmic stablecoin, which is where it's transparent in terms of what the reserves are. Like it's kind of like what DAI is trying to do, and UXD as well. Protocols like that stuff is probably fine and shouldn't be regulated because it's fully transparent and fully decentralized, and there's no middleman controlling funds. Now let's go to the other side of the equation: the asset-backed stablecoins. So you've got things like Tether, USDC, which is Circle. You've got Paxos has got one, etc., etc. These coins, as Sunny said, are supposed to be stable in value. But the stability comes from trust. So you have to trust the underlying counterparty holding those funds. So whether it's Circle and what they're holding it in. Are they holding it in US dollars? Is it short-term treasuries? Is it long-term treasuries? What happens if those bonds drop? Like how much liquidity can they provide? Now it's basically acting as a bank. They issued you a digital token saying I've got $1 in the bank account that's worth this much, and we will manage that. And so in the real world, if a bank goes under, you've got FDIC insurance, you've got a whole bunch of regulations. In the stablecoin world, you don't have that, and people have to try. So I always say that you need regulations when something is not trustless. When something is trustless, regulations should not apply. And that's, for me, the key definition between when regulations should apply. Who am I trusting? And if there is someone to trust, then there should probably be regulations behind it.
That gets back to, Jason, your question just now about like, why is there so much emotion around this and why is there so much heat? And it's because, to your point, Vinny, like that's an outstanding point. And what happened was a bunch of people got scared, like a bunch of scammers came, right? And a bunch of people just got stone cold robbed. And the scalpel work of figuring out who was a scammer and who was not is going to be painstaking, but trust overall, writ large as a philosophical question, is low right now. However, we should remember the internet started that way too, right? We did manage to scalpel our way into a functioning internet.
You do have a geographic issue with Luna being offshore and Tether being offshore, and so how do you regulate these things, right? So I think the SEC's job and the US regular job is to protect US consumers. So these coins that are sitting offshore should not be traded in the US. I don't think Tether should be. I don't think Luna should definitely have been. I think that if you want to have access to US citizens, it should be in a regulated stablecoin like USDC or similar, because now we're trusting. I have no faith in Tether. I don't think I've ever held Tether in my life. Now, I do think they probably have the money there, but I know for a fact at one point they did not have all the money. They were totally insolvent. They were underwater. They printed their way up. Bitcoin went on a run. Whatever the case is, they're probably okay now. And people ask me, is Tether okay? Probably is the answer. Okay, is Binance BUSD okay? Probably is the answer as well. It doesn't mean it's always been the case. It doesn't mean it always will be the case. But my point is, there's no transparency, and I can't see it on chain. I can't see what the liabilities are. So even this whole proof of reserves thing that Binance is doing and the exchange are doing,
attestations.
It's a little crap.
That's anti-crypto. The whole point of crypto was just you don't need to send me an accounting form. I look myself. So they're non-crypto people. Mm-hmm. That's been the problem here, is that these intermediaries are coming in and they're breaking the crypto rules, which are it's programmatic, it's transparent.
Yeah.
People don't appreciate what I tweeted about this a while ago, but proof of reserves without proof of liabilities is meaningless. I can show you a bank account with $100 million in, and you'll be like, Vinny's got $100 million cash in his account. That's amazing. if I borrowed that from a bank and I don't disclose my liabilities, I'm zero. Okay.
I literally was going to J-Trade Snap, and I looked at Snapchat like, I don't know, 6 months ago, 9 months ago. I was like, oh, they have $5 billion in cash. I was like, oh, this is great. And they're like only losing like a little bit. And then somebody's like, they got $5 billion in debt. I was like, wait, where's that? And I'm like, oh, the balance sheet. I'm like, oh, I got to read the balance sheet. It's like, yeah, you got to read the balance sheet, dummy.
Yeah.
Molly, you were on air with me, and we were like, let's break this down. And like, it was like so much debt. I'm like, I've never heard of a company that small having that much debt. And they got to pay that back.
Jason took off the J-Trade specs, put them down. He backed away from the phone. It was a no-go.
But I was like, this is where the SEC helped, right? Because they're forced to disclose that publicly, right? They're forced every quarter to put that out there, right? Their balance sheet, their financials. And so you could go and understand that.
Yeah.
And you know what's really powerful about like using these definitions is that if the SEC said, look, if something is trustless, we're not going to touch it. That would be amazing for the industry. That would actually spur more transparency. That would be like it's. I think it's actually just net positive if we move to more trustless layers across DeFi, across everything. The one area where I think needs a look is obviously, and my background here is identity. KYC, AML, those regulations, you can still do it trustlessly. Like Civic's got this technology. We can drop a pass in your wallet. We can verify your identity. No one needs to know who you are, but we can verify things about you. U.S. citizen, not an OFAC list, etc. Now you can use that wallet to transact. And this is practically trustless. I mean, it's really a trustless type of solution. So distributed identity, decentralized identity, and just a hands-off approach, the more trustless your system is, will help crypto developers not take shortcuts. Because right now, it's really easy to do a shortcut. Let's just go partner with Coinbase for staking, and let's go partner with this other company for staking, and let's like outsource all this stuff, and let's spin up something very quickly. But there's just too many counterparties, and there's too many risks in the system. And so my view is that the SEC should be a lot more aggressive with pushing people to trustlessness and transparency, as opposed to trying to force regulations into the space.
Well, here's my question, Sonny, to give the SEC the benefit of the doubt here. One of the things that we ironically have complained about, we being consumers and retail consumers, and me and Jason on this show, is that the SEC has been slow to act. They've been very hands-off in this industry, which I think we can say is true. Now the SEC is coming in and the CFTC is coming in, and they're saying, we are 100% cracking down on things that we classified as securities, on staking pools, on crappy financial tools that rip people off. There is, would you agree, no sign that the SEC or the CFTC are coming for the trustless aspects of this technology, the underlying, the fundamentals?
Yeah, I mean, it seems that way. Like, again, just that video, I think, makes it very clear, right? They're not fundamentally coming after a blockchain. They're not saying, hey, you can't launch your own blockchain. And I think they are coming after the folks that have financialized it. And you can just see that in their actions. It's only the companies that kind of break Vinny's rule about being trustless that then require trust, right? And so they're, right now we haven't seen them come after, say, Aave, right, Vinny? Right, which is like a trustless borrowing network. And so, you don't see that in any of their listings, or SushiSwap or Uniswap or any of those type of.
I have to say, this feels like about the right amount of time.
Get it? Exactly.
It feels like the right amount of time. I know that our industry would like these agencies to work faster, but I'm looking up online. BitUSD is claiming to be the first stablecoin launched in 2014. These things became hit, Tether came after them, et cetera. And then like staking pools, what is that? Like that was, proof of stake has been around since the beginning, right? That's 10 years, Vinny. I don't know what the first lending product was, but that's got to be 5, 6, 7 years ago.
Proof of stake, yeah, probably 10. Ethereum kind of pushed the envelope on that. But they only.
What was the first lending? Do you remember the first time you heard of a lending? Like, hey, lend us your stuff. We'll give you some APY. We'll give you some extra tokens. What was the first one of those?
2017, I think, Sonny.
Okay, so like these things take.
There was stuff like Mastercoin and a few others. Factum. A lot of the earlier blockchains play with instantiations of this, but it never really took off. I think It's like DeFi really took off in 2018, really, like when we started like post bubble.
So looking at this, my take on it is original crypto technology was just and sound, distributed without a lot of grifting in the in-between. You get a bunch of grifters in who try to centralize it and take advantage of it. They're getting smacked down. Some of them are good actors. I believe Coinbase is a good actor. I believe Circle's a good actor. Other ones are not good actors. I believe Tether is a bad actor. I believe Luna was obviously a bad actor. We could all have our differences here in terms of which ones you think are good actors, bad actors. And now the SEC and other agencies have to sort through this mess. And Meshuggah, it's going to take them a little bit of time. Should they have moved faster? I guess. Should people have played by the rules a little bit better? Of course. And here we are. I think we're close to having a framework. I don't think we need a new agency, Vinny. I think the existing agencies have to learn the new tricks, and we're close. But I do think people like Circle and Jeremy Allaire and Brian Armstrong should be invited. They should be, engaged civilly and seriously by the SEC and these organizations, because I believe they are good actors and they're trying to do it right. But they should also not have their employees front running. And this is where I was like, hey, Brian, don't tell me I'm getting duped when your own employees are being convicted of front running, or employee. I don't know if it's multiple at this point, but we can pull up that tweet or you can pull up the actual story. You got these crypto companies have employees front running the market, knowing when things are going to get listed on Coinbase.
But just a defense here, Jacob, that's could be just a bad actor within the business.
Of course, it's a bad actor. Yes.
It wasn't a design of
could happen
Coinbase
anywhere.
to do that. Yeah,
but
exactly,
I think then going,
Definitely
this is back to the arrogance we're talking about. To go after people and tell them they're getting duped. For Brian Armstrong to tell me I'm getting duped is just insulting.
I mean, look, let's be a little bit more balanced here, right? There are bad actors and good actors in this industry, and there's probably
in all industries.
In all industries, and there's probably more bad actors than good in crypto.
Boiler room is a great boiler rooms.
Jason, you're not wrong. You're not wrong when you say that most of crypto is a grift. Like most of it is a grift, especially the stuff.
You feel that way?
Yeah, I feel that way. So
you're disappointed in it, and you're fought against it.
But also, even within traditional finance, Vinny, right? Like to this day, right now, and I don't have it handy with me.
I wouldn't say most, though. I wouldn't say most in venture capital is a grift.
I'm not saying that.
No, we're talking about
even
finance.
within a hugely regulated framework. There's this public company which is like a sandwich shop out of New Jersey. Have you guys seen this?
Oh yes, I remember that.
Yeah.
This is a publicly listed company, like on the NASDAQ or New York Stock Exchange. We can maybe pull it up as we're doing it here.
Yeah.
It is insane. That thing made it all the way through, and it's like a sandwich shop. And so this type of stuff is occurring everywhere. It's not just limited to crypto, right?
This is unbelievable, this story.
When there's a bunch of money to be made, grifters are going to come in. And there was a lot of money to be made in crypto, and a lot of grifters came in. But I'm going to take the really unpopular opinion here that I actually think Gary Gensler gets it. I think he 100% gets it. And I think he waited until the grifting was, too big to ignore until there was, until there was enough delineation, right? Like, I do not believe he is coming in trying to nuke all of crypto. I think he is attempting a scalpel move here, and it might be tough. And you can debate the timing of it, but like the fact is, like I see no sign that he and the SEC at this exact moment don't understand what they're doing here. What they seem to be saying is this financialization is BS. And now let's talk about sandwiches.
Well, yeah, I can't leave the audience hanging. 3 men charged with fraud in $100 million New Jersey deli scheme. This is why I'm the world's greatest moderator, because when I hear something that's just incredible, I have to stop the show and just recap it for folks. 3 men were charged in various crimes, including the CNBC, including securities fraud in a scheme involving a small town, New Jersey deli. Your hometown deli, that's the name of the deli, was operated under an umbrella company called Hometown International. You put the international there, it makes it more formal. It became known as $100 million deli. Junior there with the same name. Cooker, face stiff prison sentences and fines for allegedly manipulating markets and defrauding investors. The men were charged with fraud.